Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money weekly roundup, our debrief on the biggest stories in markets and economics. No shortage this week, as usual. I am Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
I'm John Stepek, author of the Money Distilled newsletter and senior Bloomberg reporter.
Not really much to talk about this week, is it, John?
Nah,
Bit
it's been
slow.
a bit dull one.
Bit slow.
Slow.
Now, listen, of course, it's not slow at all. It's very, very busy. Lots going on. All very exciting. We have had the Bank of England out making yet another decision on interest rates. And, John, this one is interesting, right? I mean, it's never that interesting, but it's more interesting than usual this time because while they have done what everyone thought they would do, they haven't done it with full consensus.
Yes, it's interesting in relative terms.
Yeah, we take what we can get, don't we?
Well, yeah, we got a five-way split. So three-way split.
Three-way.
Five-way would be great. So three-way split. So 5 people voted to cut by a quarter point, 2 people voted to cut by half a point, and 2 people voted to hold. And the reason that was a surprise is because basically they thought everyone would vote for a quarter point cut, except for Swati Dhingra, who's very, very dovish, and they thought she would vote for a half point cut. So as it turns out, having 2 people on hold is actually quite hawkish, or it makes it look as if the Bank of England is kind of wanting to keep interest rates a bit higher for a bit longer than perhaps everyone had expected or maybe even hoped. I mean, my own view, like 4.25% when inflation's kicking around about 3 and probably about to go up to 3.5% seems about the right level for interest rates. But equally, the kind of bottom's falling out of the oil market, so hopefully that means energy and petrol prices will come down quite fast. So that'll probably give a bit of cover for the Bank of England in the next 9 months or so to carry on just gently, gradually cutting interest rates.
And that's the general feel, isn't it? That there'll be cut after cut after cut, and we'll end the year at 3.5% or something like that. That is what everyone generally expects. Yeah. And it's all based on the assumption that inflation will end up coming back to where it's supposed to be for reasons that no one knows, but nonetheless where it's supposed to be at around 2% in the medium term-ish. So that's the expectation. But of course, there's a million risks to that because as everyone keeps saying, we live in an increasingly uncertain world with geopolitical conflict all around us and the ongoing uncertainty of Trump's tariffs all over the place. So actually, as I'm sure we often say on this podcast and everyone says on all their podcasts at the moment, no one has the faintest idea what's going to happen next.
Yeah, I mean, to be fair, this is one of the times where I felt that the Bank of England's it was in a better place and a more confident place today because it was talking about, well, look, actually, one of the reasons it's a three-way split is because we don't know what's going to happen next. And I thought they were actually fairly straightforward about that. And I mean, actually, it was the same with the Fed. So the Federal Reserve was basically saying the same thing. We're not cutting interest rates. We don't know where things are going. We're sort of justifying this by looking at backwards data that isn't even up to date yet, but we just don't know what's going to happen next because of the whole tariffs thing. And I think, I think that's reason. It's more honest than everyone usually is, which has to be an improvement on what we normally get.
I've just been reading one of Albert Edwards' notes, and he pointed me towards another note, which is super interesting. And I'm going to put the link in the show notes, but it's one of the few pieces that I've read so far which says that all this uncertainty is absolutely great. Thank goodness for it. It's about time that everyone accepted that the future is incredibly uncertain. And one of the difficult things about previous bubbles has been the idea of certainty. So when we had the Greenspan put, for example, and everyone constantly believes that things will happen in the same way, and in a very clear and straightforward way. And that is what leads people to take intense levels of excess risk. So if people accept that the future is uncertain, the price of money will be more normal and people will behave in a more normal risk-adjusted way. So this injection of uncertainty into markets and into the global economy could, in that sense, be seen as a good thing rather than a bad thing.
Yeah, I think it's a really good thing. And I think that's a really good point. Because you're right, one of the reasons that capital gets misallocated is because people's assumptions are too comfortable. And one reason that momentum investing has done so well is because if something's been going up, then it will keep going up, is the belief. So it's kind of good for our, value investment by neglected assets type attitude as well. But yeah, and it's good to recognise the uncertainty. But I mean, I suppose this is also the reason why it's so. It's the fundamental problem we have in central banks constantly setting interest rates in the way that they currently do as well. I still think the idea of choose a number, make it 4%, probably 5%, 4.5%, whatever, and just leave them there.
Yep.
And then do what basically already happens. The markets kind of decide the interest rate around that, and then you don't have to have like 9 people in the room deciding what the interest rate should be. Instead, you've got the entire, global financial markets deciding what interest rate should be, given various kind of bits of information from all around the world. So that would be much better.
Okay, John, so let's go back to markets. Let's go back and look at the US market, because we've talked about this a lot over the last few weeks about how extraordinary it is that after everything that's happened and all the extreme movements in the US markets over the last, in some weeks you've seen, record movements up, record movements down, record numbers of days up, et cetera, all sorts of extraordinary things. But we end up roughly where we started. And we can also see that retail investors in the US and in the UK have been buying and buying and buying into the US market, buy the dip, all the way through. Which suggests there's an awful lot of market participants who are not recognizing the uncertainty and not recognizing the new approach to risk that ongoing uncertainty should mean that they take. Right?
Yeah.
And an awful lot of people who think that the correction is over, much of it has been reversed, and that's that. Whereas older hands, like maybe you or me, some other old people out there, might say, but this is what bear markets do. This is what they do to you. They give you a sudden drop-off, and then after a little while of everyone feeling a little panicky and some people selling too soon, they come back. And you're like, okay, I should never have sold. Buy the dip. And that can happen 5, 6, 7 times on the way down. And it can get you every time.
And what is it, like markets climb a wall of worry, but they go down a slope of hope?
Yes, slope of hope, exactly.
One thing I would point out is that obviously the dollar has dropped a lot in that time. So if you are outside the US, then actually you've still lost about 10% in the last month. And that's one interesting comparison between this and between Brexit as well. It's like most of the adjustment was felt in the currency rather than in any of the asset prices as such in domestic currency terms. But also I think the other thing is people, and actually one of the mainstream financial journalists that we like elsewhere, Mike Bird, was commenting on this on Twitter at some point, asking about like why are kind of retail investors kind of like piling back in buying the dip. And it's that thing where it's been so much the right thing to do
for so long,
for the last 15 years or so, that it's no surprise that people have been trained into doing it. It's, BTFD has been absolutely the correct strategy to kind of follow. And there is also, I guess, there's also that slight element of financial nihilism, where it's that people have talked about, where it's kind of like a bit like Bitcoin and kind of holding Bitcoin and hoping it's just going to keep going up. The same with the S&P 500 is the only game in town, and so you might as well put all your money in that. You only live once type attitude.
Yeah, but John, there's a new
shot.
Game in town. There's a new game in town, right?
Yes,
there is one country out there, much derided by investors across the world. No one has invested in this terrible market for a very, very long time. But this country has this week alone done 2 trade deals.
Yes, not one, but 2. Fantastic. It's as if all of our Brexit benefits are landing at once.
Just like that.
Yes.
Yeah. And it is, of course, the UK, where you can buy shares on a massive discount to the US and quite a hefty discount to the globe as a whole. But suddenly, with these trade deals, it's looking a little investable, right?
Yeah, aye. And I don't think, because we don't actually have the details of the
No,
US
we don't.
deal
We
yet,
don't.
but yeah, I think from the point of view of the UK's PR, if you like, at the end of the day, we've got a time when people are finally wobbling about US exceptionalism.
Yep.
And they're thinking, well, where else can I invest? And, well, that includes basically the rest of the world, because the rest of the world has lagged the US. But one thing that the UK does have going for it is that it's quite a familiar market, and it is cheap. So all we really need to do to nudge some of those global fund managers who don't actually pay that much attention to stuff is to get them thinking of the UK as actually that's kind of investable again. Oh look, they've done a deal with the US, they've done a deal with India.
Yeah.
They can't be completely useless. Let's just stick some money in there now. And I think that would really help, because I don't know if you saw the last numbers from Callisto, the financial flows. It's like, again, I mean,
I know.
There was a bit less money flowed out of the UK on a monthly basis, but that's like 4 years now of consecutive outflows, except for a glitchy bit to do with the capital gains tax changes. So it's something. There can only be so much money left to come out.
I mean, it's grist to the mill, all that, isn't it, John? Of the people who would like to mandate pension funds in the UK to invest in UK equities. And I see that today, Ross Altman, one of the old former pension ministers, today her suggestion has been that every 25% of every new contribution into a pension fund, be it into an auto-enrollment or into a SIP, 25% of every new contribution should be obligated to invest in the UK or to be invested in the UK. And she sees that as perfectly reasonable on the basis that it goes in income tax free and you can take out not quite 25% anymore, but 25% tax free when you invest the fund. And on that basis, she sees this perfectly reasonable that 25% of each new contribution should go directly into the UK market. That's slightly more than some other people think, but nonetheless, this is now a very accepted idea that we are so close to mandated investment in the UK as a sort of payback for tax relief. And it's not going to take that much of that to turn a market that has been this underinvested in for so long around.
Yeah, I agree. I think it's a shame that this has now become such a big talking point, when, if I'm 100% honest, I think this would turn around naturally anyway, because the defined benefit selling that drove this in the first place is now basically done.
Yeah.
And it's defined contribution pensions through our auto-enrollment pensions that are getting all the flows. And given that we're now moving out of the US outperforming everyone else, I think that we're going to see money coming into the UK anyway. So, but, at the end of the day, at this point, if you are someone who's thinking about investing in the UK, all of the regulatory as well as the fundamental backdrop is kind of pointing your way. So I'm not going to knock it.
Yeah. Okay, well, that's all good news.
I know.
I mean, it kind of is, right?
It's so cheerless, but it's actually
it's
good.
Yeah, I mean, I tried to bring you in there to end this whole thing on an optimistic note, with you saying how marvelous it was and how you were rushing out to stuff even more UK equities into your SIP so that you could be the great beneficiary of the coming bull market in the UK. But you fluffed it, John.
I want to beat them to it before they force me to.
Okay, fair enough. All right, well, I think we will leave it there on a mildly optimistic note, and we will come back to talk about the trade deal between the US and the UK in more detail next week. We haven't seen the details as we speak, so we're not going to bother you with our unformed views on it quite yet.
We'll do that next week when we're still as unformed.
Unformed views next week. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Moses, and questions and comments on the show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.